Hey guys and gals, thanks for joining me. Here's another podcast, and actually today we're going to spend most of the time a little Q&A session. Had a couple questions come in, and I figured I'd answer them on a podcast. So I'm not going to spend a bunch of time on the market. The Dow Jones did finish up about 112 points today. Kind of was up about 80, kind of flatlined, and we rallied into the close. The NASDAQ finished up 0.5% up 17 and to 32.52, and the S&P was up 12 points to 1563, up about 0.75%. And as we talked about in yesterday's podcast, we're kind of gyrating here at these old highs. And I will say that right now, if you look at the market today and you compare it to when it hit this high, let's say 6 or 7 trading sessions ago, I guess this was on March 14th. We're not seeing some of the same internal positive characteristics that you would hope for. For example, if you look at the stocks on the New York Stock Exchange, take all the stocks, and you look at the percentage of them that are above their 10-day moving average, which is a very short-term moving average, but it gives you a sense of, overdone or one way or the other, how much strength's going on. Right now it's at about 54%. Now, back on March 14th, which was right here, the number was 83%. So you're not getting quite as many stocks kind of in that uptrend now as you were then, even though the prices on the indices are the same. Also, there doesn't seem to be the lack of intensity. There's only about 70% of the volume today was up volume on the New York Stock Exchange. So just be careful. We're at these highs, and the market appears to be losing a little bit of steam. And so, again, don't get whipsawed. It would have been very easy yesterday to sell, and then you come back today and you see that it's running up, and so you buy at the end of the day, only to see the market maybe fall again tomorrow. So be careful up here. Things are looking a little still stretched to the upside. The one positive that I do see going on right now, well, there's several positives, but the main positive is this little sideways pattern we've been in for the last few days. What's happening is a lot of the indicators that I watch, these internal indicators, kind of these oscillators that kind of, let's say that they go in between and kind of do this. What's happened is they're working their way back down the bottom, and yet the prices are moving sideways. So that's good. So we're kind of getting a reset without the market coming down. But we're going to enter an inflection point coming up here very soon. And I talked about this yesterday evening, that we had this, these definite periods of support for the market. So we bounced off it, and now what's happening is it's converging into this old high, and it's converging into this line. And so it's either going to break down or it's going to break, but something big's going to happen. And look, I think for this market to be, I guess, sustainable, it would be healthier for it to pull back a little bit, for the fear to spike a little bit and go up. But that's not what markets do sometimes. Strong markets sometimes don't let you in, and they just keep going up. And so, again, have your systems in place so you're not having to make these emotional decisions one way or the other. And there's many of you still, and I talk to you every day, many of you still are way too underinvested and just clamoring to get back in and saying it's too late, I missed it, but I got to do something. And you're going to make a mistake because you're going to go pile in at just the top. On the other hand, there are those people that are very heavily invested and are getting very, very complacent. And we saw that we're only one crisis away from something affecting the market. It's Cyprus right now that it could have this trickle effect. Remember, yesterday, what we saw was a Eurogroup finance minister. I won't even pronounce it, but it's, well, maybe I'll pronounce it. Jiren Zillabloom. Zillabloom. You can't even Google that because you can't spell it. But anyways, this Eurogroup finance minister, basically, one of the reasons the market was down yesterday because he said that what's happening in Cyprus, where you're basically confiscating depositors' money from the banks, is a nice template to use for the rest of future bailouts in the Eurozone. And so once again, you look at that and say, that's a template? So if you're holding money in European banks, what are you going to do? You're going to take it out and you're going to put it in American banks. And so again, I think if you look at the dollar here, and this is a dollar exchange traded fund, But if you look at the dollar, it's going up, and it may continue to go up as money comes into the U.S. So the U.S. still seems to be the place to be. Emerging markets are getting hammered right now and continue as you see the emerging markets ETF going down. Had a little bit of a rebound today, but it's been going down while the U.S. markets are going up. So money's been rotating out of there, coming into the U.S. And so we have this kind of Goldilocks scenario that I mentioned yesterday where you have the Fed acting as if we're Europe and really pumping a lot of money in, continuing to buy $85 billion of bonds every month. And at the same time, you have our dollar going up, which is keeping a lid on some commodities, and yet our stock market's doing very well. So it's and interest rates are being held at bay. So again, what's the missing ingredient right now is how are the earnings going to come in? And so that's kind of the next hurdle for the stock market. But for the time being, our stock market continues to be the place to be. All right, let's move to the questions as I promised. And first question is from RL. I'll just give the initials. And he says, Karl, I've enjoyed listening to your podcasts and find them quite informative. Do you think investing in ETNs is wise at this time, considering the marked increase in popularity and potential for a bubble effect? I'm most curious about ETNs, considering the potential for lenders to lower standards due to the increased popularity of this investment vehicle. Let's first talk about what an ETN is. You've all heard of an ETF, an exchange-traded fund. He's talking about specifically an exchange-traded note. Now, before we answer his question directly, let's talk about some of the differences between exchange-traded notes and exchange-traded funds. Exchange-traded notes are similar to ETFs. They're meant to get you a broad diversification, maybe linked to some type of index, so you can just go in there and you're just trying to participate in some index. But they're similar to ETFs, but ETNs are actually a debt instrument. So they are issued by a bank, and what happens is that bank promises to pay the investor the return of the underlying index minus any fees at maturity. So these do have a maturity. Unlike an ETF, which goes on to perpetuity, exchange-traded notes have a maturity. Now, they're way out in the future, but they promise to basically say, hey, between now and the end of the time, we will give you the return very, very similar to what this index did. And then basically that's that, and you get that on that particular day. Now, the risks can be higher in ETNs simply because whoever issues these, it's a debt instrument, and you're buying essentially on their paper. So you have to look at who's issuing these ETNs, and you have to feel comfortable with the credit worthiness of those particular issuers. Now, these are tax friendlier. Exchange traded notes are actually a little tax friendlier. Usually you'll see ETNs in the commodity space. And what happens with exchange traded funds that try to do commodities, when you roll the contracts forward each month or each couple of months or whatever the case may be, there's a lot of inefficiencies, there's a lot of tax complications, and ETNs are much friendlier because all they're doing is basically saying, hey, we're going to pay you what the return of the index is, so they're promising to do that. Whereas an exchange-traded fund, they're actually going out and physically buying the securities, so they have to replace them, and there's tax inefficiencies, and there could be K1s, and there could be all kinds of more complicated issues with taxes. So exchange-traded notes are much easier from a tax standpoint than exchange-traded funds, but exchange-traded funds are much more popular because they really started in the stock world, and that's because they mimic the S&P 500 or with the SPY or the Qs with the QQQ. And now in the last maybe 5-6 years, we've got a lot with commodities and a lot of very sophisticated ones. Now, to answer his question specifically, are lenders going to lower their standards? I don't think lenders, they shouldn't be lowering their standards. I don't think they will lower their standards. And the popularity that we've seen, I don't think there's a bubble yet in these exchange-traded notes, because I really think that what's happening here is, I would equate it to what's happening in the housing market. A lot of people say that the housing market isn't as good, the recovery isn't as good as we think, because what's happening is somebody gets foreclosed on. The family goes and lives in an apartment for a while. An investor comes and maybe buys a house and then rents it to that family. And so one home got foreclosed on, another home got purchased, And so net, nothing new happened. So they're really looking at what are the net effects of this, and we're not seeing a lot of net new purchases. I don't know if I necessarily agree with that, but the reason I'm telling you that analogy is I think in the ETN and ETF world, what you're seeing is money coming out of mutual funds and is in exchange is going into either exchange-traded funds or exchange-traded notes. And so there's a tremendous growth of exchange-traded notes and funds. I use them a lot. Hedge funds use them a lot. Very easy to use. I would say from your standpoint, RL, what you need to be concerned about is the volume in some of them. Will these ETFs or ETNs even be around, the specific ones you're looking at? There have been a lot that have been delisted. Some very popular book writers, some very popular money managers have tried to start ETFs and ETNs, and they're not getting off the ground. They're not getting enough assets in there, and so they eventually just liquidate. That's what I would be concerned about. Also, if you go back to the flash crash day of May 10th, I believe it was 2010, May 6th, 2010, something like that, you'll see a lot of ETFs and ETNs really got slammed that day. Go back to the financial crisis. A lot of them got slammed. Those trades weren't reversed, and so you have to be careful with the liquidity. So, yes, when you're dealing with ETNs, look at the issuer's credit worthiness. I would also look at the volume, and some of them have very sophisticated, it says they're going to do really neat things, but when you really analyze it, they're not as different as anything else. And so the name may be sexier, but it doesn't really, on a practical purpose, do anything other than maybe some more popular ETFs or ETNs. So I would be more concerned about the specific ones you choose, but I wouldn't say we're in a bubble. I think, yes, there were a lot of mutual funds created back in the day, back in the late 90s, too many funds, and a lot of them closed. And there's a lot of ETFs and ETNs, and a lot of them are closed. But they're here to stay, and I would embrace them. Just be careful and do your research on the ones that you're looking at investing in. But as far as the lowering standards, I wouldn't be worried about that. I think, if anything, they may tighten the standards as they become more popular. Okay, thanks for the question on that one. All right, the next question comes from PN in Houston. And basically his question is, he says, Karl, what's your opinion on oil service companies like Schlumberger, not Slumberger, or Schlumberger, Schlumberger and Halliburton, SLB and HAL. And as you can see, both of them, Halliburton's moved up a little bit in the last, really since the election, has had a nice run. It's gone from 30 to 40 bucks. But going back all the way until 11, a lot of these stocks are still pretty low. The reason I think these have been heading down in both of these is because their revenues, both of these companies, their revenues have been declining. So what you're seeing is you're seeing the growth of the revenues really slow. It's almost similar to what's been happening with Apple. Apple, while it's a wonderful company, I own it, I like it, it's great, and it's cheap, and blah, blah, blah. The margins have compressed a little bit, and their revenue and their earnings growth rates have slowed. So maybe revenue was growing at 40% one year, then it was 30 the next, then 20 the next, then 10 the next. And so investors aren't paying a premium for these companies. And so what's happened is while they may look cheap from a valuation standpoint, when you go back a few years, I think it's deservedly so. Now, if you think about what's going on in the Bakken Shale and the Eagle Ford Shale, these companies aren't going anywhere. They're going to be around a long time. So I like them, but do you want to own them individually, or would you rather own, let's say, some of the, oil and exploration companies? They're also, here's the equipment and services ETF. I would rather go with an ETF right now than with the individual companies. You're not going to get maybe the dividend yield or something like that, but I do like these companies in a basket. And on his follow-up, he was talking about that, oil had broken out recently, and he's using USO. And one of the things I pointed out on a podcast was I talked about that I thought it could bottom out around this area, and it indeed did. And we've seen a nice little move up in USO, which is the oil ETF for that. And I don't necessarily like using USO for oil, but what I would say is watch the price of oil, and then you can go buy those stocks or that group with it. And I do think oil has a good chance of breaking out here. I mean, you can obviously see that it's very, very close to that level of breaking out. You'll notice we'll have this kind of wedge pattern. So oil's very close to breaking out. Of course, it could reverse also. And one of the things, in kind of a follow-up to his question, was he was talking about the dollar and why we haven't seen companies like Freeport-McMoRan and U.S. Steel and those types of companies doing well. Well, it is a direct relation to the dollar. I mean, we have the dollar here, and it's been strengthening. And as I mentioned earlier, because of the problems going on overseas, I think that's only going to further add to money flowing into the dollar. And while that has been a negative for stocks prior, it's actually positively correlated right now. So as the dollar's going up, the stock market's going up, kind of like it did in the mid-90s. And if you look at some of these companies like U.S. Steel, they've been hovering around the bottom here. They look like they may be ripe to take off. AK Steel has been just horrible, just heading down. Doesn't quite look as good as U.S. Steel. And then Freeport-McMoRan, FCX is the symbol. Again, it's hit this bottom multiple times. This is copper, metals and mining, copper and gold. But if you look at some of them, I think they are ready to take off. I have mentioned this for aggressive trade. I'm actually in the XME and looking for this to pop. And if it did pop up to the old high up here, it would be a nice trade for me because I bought it near the bottom. And if it goes up and rolls over, I would take profits on it. So this is more of a technical trade, not a real fundamental move. So I would still stay away from the steel companies and companies like that, simply because if the dollar continues to go higher, it's going to continue to keep a lid on a lot of those companies. So that's why material stocks seem to be having this big lid right now. So it's all because of the dollar. And again, as a consumer, if oil prices can stay with a lid on them or head back down a little bit, that would be good for the consumer. But oil's been moving up, even though the dollar's been moving up as well. So interesting to watch that dynamic. So thank you, PN in Houston, for that question. And thank you all for joining me here on the podcast. As usual, I appreciate it. And again, have those questions come in. It's more interesting for me to answer your questions and make sure that I'm doing something that you enjoy than just doing the run-of-the-mill podcast. I get a lot of compliments on the podcast, and people often tell me, hey, I like hearing what you have to say, so I don't want to interrupt you with some of my questions, but this is what this is about. It's a dialogue, so I want to hear your questions. I like to answer them, and keep them coming. Appreciate it, and we'll talk to you soon.